If you want to stay in the same situation, then continue doing what you're doing.
And you guys can get on board and go down this 4-lane highway and just rock it out, and you don't have to have a decade of learning process.
Meet people where they are. If you want to have all types of clients, be a Rubik's Cube. Meet them where they want to be met.
We have to know our numbers. We have to know how much we want, and then how many deals do I have to close to make that a reality?
What I want to do over the next half hour or so is give you clarity on the items that really are going to generate money for you and allow you to do the things you want to do. So
if you're not currently being coached by the people in the industry that are doing it at the highest level, then you're working too hard to get there.
This is the Next Level Loan Officers Podcast with Kenneth Travis and Sean Zalmanoff.
Welcome, everybody. Thank you very much for joining us. Kenneth, fantastic to see you as always. I'm Sean Zalmanoff, and we're here with a little special treat with the man, the myth, Barry Habib. How are you, brother?
I'm doing great. Thanks for the kind words. You guys are pretty awesome.
Well, you know, you're making us a lot of money. My team locked 7 new refis this morning, so we're heeding your words and enjoying what we're reaping from them.
It's great.
Yeah. So we were going to talk today. Well, you had some things in mind. So why don't you just share with everybody what we're going to be talking about this morning?
Well, you know, I really wanted to go over what's going on in the market, what you can expect, where prices are going, both on financing, where prices are going in the real estate market, and why things are so misunderstood out there. So I thought we'd just have a discussion in general about the housing market and about all of the events. Now, I was going to try and see, you guys do such an amazing job with your students in helping them, but I also know you're very in tune with what their concerns and their needs are. So I thought we'd just kind of talk, and you have such a good finger on the pulse. Maybe you could tell me what it is that people are hearing, what they need to understand or go deeper on, because there's so much confusion and so many things are misunderstood. I thought it'd be a good idea for us to talk about those and break those down in very easy to understand bite-sized pieces, so that not only do we understand them, but we now can be the teacher. We can now go out there and teach. And by the way, you're listening to this, you're saying, you know, if I kind of get it a little bit, you know, do I still go out and talk about it? Yes, 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 and yes. The best way to learn is by teaching. Because when you start to talk about it as the authority, as the expert, you're going to know a lot more than most people. But more importantly, you'll kind of in your own mind raise questions on areas that you might need more help. Don't panic. That's what we're here for, okay? That's what Google's there for even. You know, you could kind of research stuff. I mean, be resourceful. Start to research. Contact us. We'll help you out. We'll get you to understand all that stuff. It's easy.
Yeah. I would add to that too, Barry, and to some of what you've already said. Loan officers have to understand that we already know 99.9% more than what the consumer market knows.
Yeah.
Right. And so having that fact, like it's a fact, like we just do, we know it. Even the most uneducated loan officers out there that may not have the market talked down to where they want it, they still know more than most. And so it brings up a question. And this is what I think, because I've had these same stories in my head, especially in my earlier years in the businesses. Man, am I smart enough? Can I really say this? So what are some like real simple ways for loan officers to explain to their clients, right? Because like we hear Barry Habib speak and we're like, wow, it's like drinking out of a fire hydrant for me to have to repeat that. It would be really hard for some people to do. So how do they embrace their own DNA and be able to give this knowledge out in a way that would make sense to their clients when
keep talking about it. Keep talking about it, and it'll give you amazing clarity. If you keep talking, if you just kind of put it in a box, then you know it's just like anything else. You get dust on it. You really have to keep talking about it, and you have to bring it up. And listen, here's the thing. It is no longer acceptable for you to just know how to qualify somebody and consider yourself to be an expert, or to think about that you're safe. Richard Barton just recently, he just on Zillow's earnings call, pretty much talking about putting realtors and loan officers out of business, saying we don't need them.
Right.
Much more efficient way of doing business. Now he's got the he's got the brashness about him to do it from experience because he did it to travel agents. And if you don't know, Richard Barton is the CEO of Zillow, and this man is on a mission to put you out of business. And it's not just him. Look at what is happening in fintech. I mean, just pick up any daily edition of Housing Wire or any other publication. Every day, there is no shortage. Just the other day, Better got $160 million to go out there as a fintech mortgage company and put individuals like us out of business. So our best defense is to be smarter, because that's the thing they don't have. So listen, just like with anything else, whether it's in sports, whether it's in business, anything, you have to find your strengths. You have to find the areas where you have something special to offer that customer. And after all, this is not like buying a flat screen TV. It's different for everybody, because while the payment might be the same on a mortgage, if you have two different mortgages, the effect of the payment is different on every single person, because that $1,200 a month is going to feel different to everybody. And is there a better way for them to structure it to create wealth for themselves? And is there a better time to do it? Is there a better strategy to have? All of these things are where you shine. It's the only advantage you have, because they've got to speed everywhere else. I'm sorry to say they do. Yeah. We're not raising $160 million for this or for that. They got more money to spend than we do. They got more marketing to spend than we do. All you have is this. And you know what? No matter how much they try and spend, they can't replace this if you do it right, which is why it's so important that you really focus. I love when I come to your events, guys, because I notice the heart that people have to want to learn, you just have this, you've attracted such amazing people. It seems that what you've done is kind of magical, because the people that are affiliated with you guys not only happen to be really, it seems like as good as it gets as far as individuals go, but they really want to do better for themselves, for their family, to serve their customers better. So I admire what you guys are doing. It's really wonderful.
Well, thank you. Yeah, we have a belief system, man. You're a 10 or you're a 2. That's it. There's no I'm an 8 at what I do. No, you're a 10 or you're a 2.
So let's think about it here. There's so much to talk about, whether it's misconceptions in the housing market, whether it's the inverted yield curve, where rates going, where's real estate going, China, yuan, trade, stock market, recession. There are so many things. Pick a topic and let's just roll on it real quick. So I'll leave it to you guys.
So KT, so one thing, like that everybody listening to us in our top producer huddles that needs to know, like the intake form that we live, die by, and preach. Like Barry's talking about getting up here and being smarter than them. That's something that fintech can't replace. And that's where we really find out the meat and potatoes of where a client is, what they need, and really analyze their situation to give them the heads up and the best advantage possible. And I noticed, refis are up, home purchasing's up, the market's busier. And then people don't do the number one thing that they need to do, knocking out their intake form to really find out what's best for that client in order to separate them from the competition. So I just want to remind everybody.
So listen, just to get, so we're going to get specific now, right? Because I really want to try and put out some really good content for you guys right now. So you mentioned something, so let's run with that, okay? So the first thing you just mentioned is refis are up. Yeah, refis are up on a year-over-year basis, 180%. Purchases are up 5.3%. You might say, well, interest rates compared year over year are 7/8 lower. 7/8 lower, and purchases are only up that much. So it's because people don't understand the housing market. Okay, so let's break this down first. Let's start with the housing market, and let's really go deep on understanding it. I want to talk about recession as well. So when it comes to the housing market, it's very confusing, because the media thinks about housing as the generator of GDP and how many jobs it creates, this and that. And when they discuss housing, they completely botch it, especially people like Diana Olick, who does not understand it. When you take a look at what your customer, your realtor, what do you care about? Do you care about how it drives GDP? Well, sure, we care about that. But what do you really care about? Is this a good investment? Is the home value going to go up and create wealth? Or if I put my money into it, is it going to be a crash and I'm going to lose everything? I'm going to be upside down. That's what you care about. That's what your customer cares about. And so when we take a look at housing, sometimes purchases are a little bit slower, not because things are bad, but just because there's no inventory. Look, if you go to the store, and let's just say it was the first day that an iPhone came out, and it was like the hottest thing. It was the new iPhone. It was hot. And if the Apple store ran out of it, they're not making sales. They're not making sales because they don't have a good product. They're not making sales because there's no inventory. And have you talked to anybody trying to find a home on the entry level? And by entry level, I don't know if it's up to 300, up to 500, up to 600, whatever it is in your market. That's the largest segment of the housing market. There is very little to no inventory there. So if sales are slowing in that department, it isn't because people don't want to buy. Tons of people want to buy. That's why home prices are going up. It's because they don't have enough inventory. And the inventory levels only at a 4.1 month supply. Inventory levels are down year over year. This is, if you're trying to generate GDP, gross domestic product, if you're trying to generate transactions, if you measure it by the number of transactions, you say, well, things are slow. But how about all those people we've been telling to buy a home over the past several years? Are they happy? Yeah. They're not seeing a slowdown. They're seeing their values go up, and that's all they care about. If you buy a house today and the housing market stays good, which it will, you'll be very happy you made that decision. You'll be very happy you went through that hard work. So when we take a look at these things, we have to understand that there's really three housing markets. The housing market for your customers, either on the entry level, which is on fire, forget it. Just talk to somebody who's looking for a home. Then you have that move up level, okay? So kind of somewhere between, it depends on the market you're in. So maybe it's above 400 to 800, maybe it's above 500 to a million, depends on where you are, okay? Maybe it's above 300 to 600 and 650. That's all dependent on the market you're in. That market's okay. Homes will sell if they're priced right. If you get greedy, if you get stupid, if you price your house for some stupid level because some realtor says, hey, you know what? Oh, I'll get you this much, and they promise you pie in the sky to get the listing, you're gonna have that sit. But if you price it right, if you price it smart, if it shows smart, it's gonna sell quickly. So that's an okay market. The third market is the upper echelon, and that's slow. That's slow. And the thing of it is that one home that's slow for $3 million on a dollar basis makes things look slower because on averages, it starts to bring the overall down.
Yep.
So what I'm telling you is the housing market's hot. It's going to remain hot. And we talk a lot about recession. Now, I do think there's going to be a recession sometime in the next year, year and a half, sometime in that period. Look, there's definitely going to be a recession.
Yeah, let me ask you this, Barry, because that is a big question for a lot of loan officers that are out there. But the reality is are we looking at a recession like we've seen in 2008 and 9?
No.
Looking for a lot lesser of a recession.
So recessions tend to mirror the expansion. We had a shallow expansion. It's been a long expansion, but it's been shallow. So we'll have a recession. It'll probably be short in nature, 6 months, 9 months, something like that. Maybe 6 months, probably. A lot of recessions are 6 months. They typically don't go much more than a year. And when we do have the recession, it probably will be shallow because the expansion was shallow. If you had GDP at 6-7%, well, the recession will probably be deep. But if the expansion, which has been around 2% or so, that recession will be kind of modest, kind of be shallow. So I don't think it's going to be too bad. I want to explain to you a few things about recession. So first of all, will we have a recession? So it's so funny to hear people talk their book. Like just today on CNBC, I'm listening to these people. And a lot of people come on, oh, it's ridiculous to think about a recession. Oh, can't have a recession. Ah! So these people.
Market's up 12% today.
Yeah. So they're talking their book. So the stock market does well before a recession. Okay. Just remember that. Does well before a recession. Then it loses half its value. Okay. So they'll talk you into buying stocks until you lost half your wealth. Right. That's what they'll do. Yeah. Now, here's the thing you have to remember. I want to give you an example and specific. So today, Target, the other day, Walmart, their stock's on fire. Why? Because they're doing great. And people will say, they get these guys on CNBC, they go, how could there be a recession? The consumer's alive and well. It says, okay, let me ask you a question, guys. Why do you go to Walmart or why would you go to Target?
Save money.
To save money. By the way, they don't mention that Nordstrom's and Macy's are in the freaking toilet. Okay. So what are people doing? People are saying, I'm going to trade buying more expensive stuff for cheaper stuff. Is that a sign of strength and disposable income to you?
No.
See, it takes thinking in all of these things. The media is just on the surface. They're an inch wide and a mile deep. What you need to go is you need to go a mile deep on stuff to really get the understanding. Right. So when you think about this now, and look, some of this could be just people being smart and wanting to save money. Great, good for you. That's wonderful. However, I want you to understand that when we see the consumer doing well today, even if that were just the case and you would make that argument, how would that consumer do if they lost their job? And what happens in a recession is that it affects corporations first. And corporations have a lot to do with what's happening around the globe. And if you take a look in Europe, in many areas, it's a total slowdown. I mean, heck, Japan and China, they're geriatric wards. Okay. I mean, for goodness sakes, these countries are a mess. And when you think about our ability to do business with these other countries, it's going to, even if it slows down corporate America just a little bit, what's their first response to do? First response is to let people go. And as that domino effect starts to take place, then those people that start to be let go, they have less discretionary income, which means less purchases at Macy's, less purchases at Nordstrom's, and probably some less purchases even at the Target and Walmart level. And on top of that, less cars. And yes, less homes. So let's understand this, because a big misconception. So now that we understand a little bit about recessions and how they work, when we talk about what's going on in the housing market, why have we seen historically home values hold up very well during recessions? Let's break it down to, see, I love math because math doesn't lie. Math cuts all the bullshit, okay? So somebody could say, I think that's, blah, blah, blah. Do the math, okay? It's very simple. So I'm going to round numbers here, round numbers, okay? Our unemployment rate's a little less than 4%. There's a little less than 160 million people in our labor force. There's about a little less than 2 workers per household. But so I'm going to use just round numbers for simplification, okay? Our labor force, 160 million people. So if you took the unemployment rate, again, a little less than 4, but let's call it 4, and it went from 4%, let's say it skyrockets and goes to 7%, okay? So bad recession, people, unemployment rates jumping up, it's really, so 3% means that 5 million people would now be in a position where they would have lost their jobs. Now they're going to be searching for other jobs, and this and that. Some people could bounce, some people could tolerate it, but probably those 5 million people, or about 2.5 million households, last thing in the world they're thinking about doing is buying a new home, right? Or I don't mean new meaning new construction, buying a home, okay? So they're in a box. They're kind of like, they're probably frozen. They come out of the marketplace. But during recessions, we know historically that interest rates are going to drop. Heck, I've made my predictions on rates, and you could see I was kind of the only one out there, and people were making fun of me. Okay, they laughed at me when I told them that. I got a lot of criticism when I started to talk about 1.3%, 1.39, 1.37 on the 10-year Treasury. Yeah, sure, when it was at 2.5%, it looked like it was far-fetched, and people thought I was nuts. But here we are. We got to within 12 basis points of it, and we will get there for sure. Okay, we're going to be lower than that. When you think about the drop in rates, what it does is it brings an influx of people who couldn't purchase before, who now can purchase. That number is overwhelming. So maybe 2.5 million people are in the box, but now 5 million people are able to. So now you have an enormous appetite to purchase homes. It is why the entry-level part of the marketplace, you can't find a frickin' home. It's why if you have people in your office or your friends or your family or yourself looking for a home, you're getting outbid, you're getting frustrated, you can't find something. Why? Because people are coming into that market who couldn't qualify before because rates have dropped so much. And smart people are looking at it and say, dang, for what I'm paying to buy a home, it's cheaper than renting in many of your markets, even with a low down payment right now. And it's going to be even more appealing to buy a home than it is to rent as rates continue to drop. I think the 10-year gets somewhere around 120, 110, 1, maybe even less. Who knows? There's $17 trillion in negative debt around the world. We've racked up a ton of debt. We're going to continue to do so. And it's a proven fact. Whenever a nation racks up a lot of debt, interest rates do this. Why? Because it slows the economy. It really brings inflation down. Think about it this way. If you have a family that's racked up all kinds of debt, right? So they don't have the discretionary income. It's that discretionary income that causes prices to rise, that causes inflation, and inflation causes rates to rise. Well, if nobody's got discretionary income, you don't have the pricing pressure, you don't have the inflation, keeps rates low. Yeah. If countries, you think countries have discretionary spending? Countries are cutting. Why? Because they're compelled to pay interest in certain social programs that they have, and their remaining budget is shrinking. So they don't have the discretionary spending, which means that you don't see that inflationary pressure, which kind of is an anchor on rates. It's a fact. It's happened in China, US, UK, Japan, Eurozone. It's everywhere. So we see these things happening, team. we're going to be in a good interest rate environment. It's not going to go straight down. There's going to be fluctuations, okay? But we are, for the most part, in a good place interest rate wise, a good place home value wise, and you're going to see lower rates ahead. So think about this in your strategy. Don't load up don't pay upfront MI. That's just stupid. Don't pay a lot of fees if you can avoid that. And if the buy up schedule permits you to, buy up the rate and pay for some of their closing costs within the rate, and show them how that will be a huge benefit, because the chances are in a year from now, they're probably going to be refinanced anyway. So these are the strategies you need.
So I have a question. One of the things that a lot of loan officers talk about, because, like Kenneth was mentioning, man, the Great Recession is fresh in our mind as the last one, and, coupled with the longest economic expansion, that's, besides the tail end of the 2000s, that's the only thing that most of us remember in our career. So during
unless you really don't like me.
You're just you're just 1 year older than us, I think. So during the Great Recession, though, do you recall? So you said 4.1 month supply of homes on the market right now. It was, what was it, 9 months? Was it a year of supply of homes on the market?
Because here's what happened. It was very different circumstances, guys. Okay, so the confusing point that people make is they associate the previous recession, the Great Recession, with the housing bubble, thinking that the recession caused the housing bubble. It's exactly the opposite.
Separate things, yeah.
It was the housing bubble that happened first that was due to crazy excesses. It really started in the early 90s when the government said, hey, we want to have home ownership for everybody, which was really a stupid idea. It sounds nice, but it's stupid, okay? So what happened was that the idea of home ownership put people in a position of making these programs available to individuals who really should not have been in a position to take on the risk of home ownership, because it truly is, part of it is a risk. And eventually it got crazy, because then the search for putting capital to work created pools of money that mortgages went into, that created 580 FICO, no income, no asset, no job, fog up a mirror, you're approved. And that craziness, no other way to put it, caused a bubble that occurred beginning of 07. And as that bubble started to deteriorate, it really spread everywhere, and it led us into the recession, which occurred 2 years later. And that recession then was associated with the housing market, but it really wasn't it wasn't something that hurt housing. Housing caused the recession. And interestingly enough, during that recession, home prices actually tried to go up as interest rates dropped, but then it just caved a little bit further down due to the weight of all of the, you had 25% of homes were in foreclosure and underwater, and it was a mess. If you were the unlucky person and bought your home the day before the recession, you're a really happy camper now, because 10 years ago, and most people stay in a home for 10 years, your value's gone up very significantly since then. So even though it dropped, it's gone up a lot. So remember that.
Yeah. So how does the 10-year Treasury, at least what you see coming, right, equate into interest rates? What would you tell people
so the 10-year Treasury is not going to, mortgage bonds and 10-year Treasury is not going to be in lockstep. Your rate sheet as a loan originator is going to exactly follow mortgage bonds. Okay. So, but the 10-year Treasury is a good guide for the direction and the flavor. It's kind of like, look, if you have an individual stock and you say, wow, the Dow was up 200 points today, good chance your stock was up. Okay. Or the Dow's down 300, good chance your stock was down. It isn't exactly the same percentage, and it may not be up or down exactly in line with, or even it might have traveled in a separate direction that day. However, it's a good barometer. And that's what you use the 10-year Treasury for. And the 10-year Treasury does help you in predictive analytics as well. So that's why we use the 10-year. Much more volume, good for predictive. But the 10-year will follow even less with mortgage bonds for a few different reasons. Number one, as we know, it's not always in lockstep anyway. Number two, when the Fed decided that they were going to start reinvesting maturing mortgage bonds and treasuries, they're no longer going to put them back in mortgage bonds. They'll just be treasuries. So now even more of a disconnect. And number three, duration. And here's what I mean by duration. So guys, let's just say, KT, Sean, you guys are fund managers, okay? And you kind of put a fund together and you say, well, what we're going to do is we're going to buy different bonds. You can't just tell your customer, give me your money, I'll put it in what I feel like waking up tomorrow and investing in. It's like, oh yeah, I'll invest in this. No, you have to be specific and tell your clients what you are focusing on, and in your prospectus, what your goals are and where you're going to invest their money, so they know what they can expect. And what you might say is, we're going to do like longer term bonds. That's what I'm going to put my money in. And you want to have a duration of, at least 7 years to to 10 years in that range of a duration, meaning that's the life of it. Why is that so important? Under normal circumstances, they have a little bit more risk to it, but you can get more reward. In other words, if I do a bond that's, or bonds that have a much shorter duration, maturity, if they were 3 months or a year, much less risk, but chances are I'm not going to get as much reward. It's closer to like putting your money in the bank and getting, those types of results, right? So I'll go further out to get more yield. So at least the client knows that they're taking on more risk for that duration. Well, can you buy mortgage bonds thinking that like normally they'd last 5, 7, 10 years? Can you?
I think they're all going to be refinanced in the next
Yeah,
Bang, there you go. So now what do? You say, holy cow, I got a bunch of my mortgage bonds that I've already purchased that if I take the weighted duration of those, I was expecting them to be 7 years. Now maybe they might be 2 years if I'm lucky. So how do I stretch the duration to get my portfolio 5 to 7 years again? What do I have to buy? 10-year treasuries.
10-year treasuries, right.
So you start buying 10-year treasuries, you wait, your more weight on 10 years brings your duration back up to within the prospectus so that you're more in line. So this is something that has a funny name. It's called convexity buying. And convexity buying is a spiral because as you buy, and many other, you're not the only fund manager doing this. As all you fund managers start to buy the 10-year treasury, what do you think starts to happen to the yield on the 10-year treasuries? All this money's going into the price.
Band goes
Goes
up,
up.
yield
Yield
drops.
goes down as the price goes up.
Yeah.
Because there's so much more demand. All that buying drives the price up and the yield, the interest rate itself, down. As the yield on the 10-year treasury goes down, what do you think happens to mortgage rates? They come down too. Which causes what?
More refinances.
Which causes shorter duration, which means I got to buy more 10-year treasuries. And that's why when we look at these forecasts like I did and I was out on an island, it's because people aren't thinking deep and they're not seeing. People look, I'm going to share something with, this is in my book, by the way. I'm going to plug my book here. It's called Money in the Streets. I'm so excited about it. So one of the lessons that I want to teach that's in my book, it's a lot of life lessons that I've learned. And so you guys, I think you guys know this. I'm a car freaking lunatic. I love cars. Okay, I'm a nut. And I like to spend time on the track. And I think I'm a decent driver, but I like to get professional drivers to work with me because I want to just really refine. I just want to get better. Like in everything in life, right? We want to get better at everything. So the best way to do it is to have a professional or a coach or somebody really teach it. That's why people go to you guys to get better. Here's the lesson that I learned. When most people drive, and probably the vast majority of people listening, you drive the same way. Most people don't look any further than the car in front of them when they're driving. Catch yourself doing this. You probably do this, okay? You're focused on the car in front of you. But that's not the best way to drive. And the best way to show you this illustration is what I want you to do is I want you to take a bottle of water. And I want you to go out on the street and I want you to put it about 20 feet in front of you. That's like 6 or 7 paces, 6 or 7 long steps. Put it in front of you. And then what I want you to do is I want you to look down at the bottle of water. Can you see the road ahead? Probably not very well. Now, focus your eyes on the road ahead so you see everything. Can you still see the bottle of water? Of course you can.
Yeah.
Of course you can.
Yep.
So if you just do this one thing, you will be a better driver. Do it in driving and you'll be better. But do it in life and you'll be much more successful.
Yeah.
Don't look just at the car in front of you or the bottle on the ground. Look down the road, and people don't do that. Train yourself to look at the very big picture, okay? And you will be rewarded for it.
Yeah,
so I saw this morning, or maybe it was yesterday, but German bond auction, and the price that they were paying, I mean, the yield was negative, but the price they were paying was double above par. And so with what the United States has, 80-90% of the global bond market we're print the money on. So with us being the only country that still has a number in front of the decimal.
No, there's other countries too. If France is positive, there's a few. There are several. Canada's positive, UK's positive.
There.
But you're right. 16.
But the amount of debt that we produce versus them that's available to buy in the market.
Yeah.
So is that another factor that really, no matter what's happening on the side, our yields are more attractive at 1 point something percent?
Well, people will pile into those yields a little bit more because we are the the cleanest shirt in the laundry, and people are looking at 1.5% on the 10-year Treasury, and even though 1.5 doesn't seem like a lot, when you compare it to like, here's my money and I'll pay you, it's looking pretty damn good. Now, there's differences as well in currency, okay? And what I want to tell you is that the Fed is going to they're going to have to cut probably 3 times. Doesn't necessarily translate to lower mortgage rates all the time. If a Fed rate cut makes the market perceive that could be potentially inflationary, we talked about this in the beginning. Inflation is the enemy of bonds because it erodes the fixed per payment that you get. If I issue a bond, or if I'm laying out my own money on a mortgage, I get a payment every month. The payment's fixed. If inflation starts going up over time, it starts eating away at my buying power. So every 17 years, it's kind of like half of what it is. So it means if I'm getting $1,000 a month, 17 years from now, it'll feel like 500 a month. And then if I kept it for 30 some odd years, it'll feel like 200 or 300 a month. So it starts to be less and less of value, which when we take a look at this and we say, okay, if in the United States, if the Fed starts to cut rates, and it's deemed to be inflationary, well, longer term maturities won't like that. But I think right now inflation's so low that even the Fed rate cuts, the bond market will accept that as it's not going to cause inflation. But we have to watch out for that because at some point it might cause a little inflation. So we have to be careful of that. Listen, and I'll tell you what I'm doing personally. I cannot tell anyone what to do financially. So I'm not telling you what to do financially. I'm just telling you what I have been. And you guys know this because I've been speaking to you guys, since we're back in Orlando together 6 months. I told you I'm lightening up on stocks because I feel a little bit uncomfortable. That's just me personally. I don't want to tell anybody what to do. And as you know, I've been buying lots of TLT, which is longer term treasuries, and that's done unbelievably well, and gold, which has done unbelievably well. So that's what I'm doing because I feel that as the Fed cuts, gold goes up. Longer term treasuries, because of the lack of inflation, because of the recession coming, probably continue to go up. Interest rates go down. And you want to capitalize on that in your own portfolio. But more than anything else, I'm just a little concerned. I don't know if the stock market's got another 3 months, 6 months, a year. I don't know. And it doesn't mean I'm right. But to me, I feel a little uncomfortable with this level of volatility, as well as here's the thing. I love history. Given the price to earnings ratios in the stock market, the next 10 years worth of returns are usually not very good. Every time in history, if you take 10-year slices and you go back through the beginning of time, the best times to buy stocks are when the price to earnings multiples are much lower. You get wonderful 10-year returns. Think about 10 years ago.
2008, baby. Oh, yeah.
We're seeing a great stock market now. But 10 years ago, if you were the buyer, you had price to earnings multiples so low and so attractive, they produce great returns. Right now, the price to earnings multiples are much, much, much higher. And at least I can't tell you what the next 10 years will be, but for a very long time, historically, and what makes common sense to me is that the returns are compromised going forward. So I think real estate's a great place to be. I think gold's a great place to be. And I think longer term treasuries are a great place to be, at least right now. I mean, could that change? Yeah, but that's what I'm doing right now.
Sure.
I just bought real estate, gold. I'm telling you what I'm doing, okay? So it doesn't mean that anybody should do it. I'm not giving any financial advice. I'm just telling you what I'm doing and why I'm doing it.
Well, Barry, we appreciate you as always. And for anybody who does not have money in the streets, you need to go order that book right now.
You really need to. It's just going to be such a great inspirational book. And the book it's through me, not necessarily about me, but there's a lot that you'll learn about me. Very, very vulnerable in this book. There's a lot of stuff in there. Listen, I'm just like, I'm human like everybody else, but at least
how do we get a copy of it, Barry?
Well, I'm in the process of getting it together and so it's all written out, but I'm up to chapter 8 of 18 right now of like having it final. And very flattered. Tony Robbins, Randy Zuckerberg, they both had an initial read on it. They're both endorsing the book, which is a big, big thing to have giants like that endorse the book for me. So yeah, I'm really excited about it. It's lessons for everybody. It really is. And it's such an easy read. I had the manuscript out of my trainer the other day, wouldn't stop reading it. And she's usually bolts out of there as soon as we're done. She's stuck around to read the next couple of chapters. So it'll grab you. It might even make you cry, but it'll give you lessons that you can take with you. And I think it'll really help people. That's what it's designed for. Not doing it for the money, doing it to help people.
Good stuff, man. Well, listen, at the beginning of our call, we talked about, what to say and how to communicate with our consumer market and be leaders in our communities and be the, expert person to speak to. So I want to add this, okay? One, thank you for all that you do for our industry, man. It's like second to none. You know what I mean? Like, you're just amazing. And two, guys, if you're listening to this and you don't have MBS Highway, Barry's got a very sophisticated process that allows you to basically read a script and look into the camera and smile and be very educated. Very educated. It's like a teleprompter, right, Barry? You just read it. Like, don't make it complicated. If you can copy and repeat, then like, there you go. So my plug for MBS Highway. Love you guys.
I really appreciate that. Yeah, listen, I appreciate it. I wasn't even going to mention it, but listen, we're really here to help you guys. Give it a try. I think you'll be blown away. You'll be totally shocked at all the stuff that we can do and do really well and really easy. The goal is not to put another brick in your backpack. We want to make your life easier and more effective and more efficient. And God's honest truth, we just want to make you beat your competition, protect yourself, put more good things into your life and for your family, and also for your customers. Change your customer's life for the better. And those are bonds that you just can't break. We want to have that bond with you. We want you to have with your customer. We just want to do good things for you.
I mean, Barry, I've been following you since the mortgage market guy. I told you the first time I met you, I had a minor in economics in college, and you taught me more about economics than all those classes combined. Guys, if you plug into this, you will make money. You'll be above your competition. And when they're not here in 10 years from now, you'll be the advisor that still is. And if by chance you are listening to this and you do not have our app on your phone yet, text the words right now. Text next level. It's one word to 36260. You'll get all of our information, podcast. You will have our upcoming events that are happening, and you'll just get to stay in touch.
I want to come speak at your event. I come to speak at your events. You know why? Because I believe in what you're doing. That's that simple. It's seeing the people that you help and the lives that you change, not just financially, but personally, and seeing the stuff that you all do, your whole team. We got you two guys, but your other teammates are pretty great rock stars themselves. You're just, your whole team is truly next level. The name is so appropriate. I believe in you so much. That's why I like going to that, because I believe what you're doing is doing good for people out there, not just business-wise, but the whole picture. So keep doing what you're doing, man. I admire you.
Awesome.
Thank you.
Have a great day, y'all.